Pressed by development partners and commercial banks, the National Treasury is drafting a law that seeks to repeal the Banking Amendment Act that prohibits banks from pricing their loans above 4% of the central bank rate. A new report by the World Bank says the rate caps has eroded growth in all sectors of the economy, with credit to the private sector dropping by half. The report says consumer loans share have declined sharply both in the post-interest rate cap law by 1.1% and a further 1.4% after the caps. Similarly, small and medium-sized enterprises' loans share has also declined by 0.7%. The World Bank report says in 2016, access to credit as measured by growth in credit to the private sector was 25%. However, this slowed to 2.4% in December last year, the slowest growth in over a decade. The report finds that all banks showed a significant shift in lending towards corporate clients at the expense of lending in other sectors such as SMEs, consumer loans and new borrowers. The proportion of new borrowers receiving credit from banks significantly reduced by over 50% following the interest rate caps, the World Bank report says. These findings are consistent with a September 2017 credit survey conducted by the Central Bank of Kenya, where 54% of respondents confirmed that interest rate caps had negatively affected lending to the SMEs. The report advises government to adopt credit scoring through credit bureaus, more efficient loan foreclosure procedures, and greater emphasis on strengthening consumer protection measures to protect borrowers from high interest rates.